Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 18th of September. I'm Daniel Lam, your host for the podcast. The Fed cut rates by 25 basis points to 4.25, which was in line with our house view. More significantly though, the Fed's dot plot indicator of individual Fed members showed a baseline forecast of two further 25 basis point rate cut by the end of 2025 and one further rate cut in 2026. Now the Fed's estimate of the long run rate remained unchanged at 3%. So all these arguably fell short of current expectations of a total of over 5 rate cuts by the end of 2026. Case in point to note was Powell's comment that the 25 basis point cut was a risk management cut. So the focus of the Fed has moved clearly to jobs over inflation. In its updated forecast, the Fed raised both its growth and inflation forecast slightly over the next 1 to 2 years. There was an acknowledgement that inflation remained elevated and was mainly driven by goods prices, but the punchline from Powell was that the labor market was no longer solid. He did add, though, that the Fed would be data dependent and there was not widespread support for a larger 50 basis point rate cut. So the market moves were muted, initially risk-off across asset classes, but recovered by the end of the US session to levels right before the FOMC announcement. So going forward, we're expecting short-term pullback in risky assets as the announcement slightly fell short of the excessively dovish expectations from market participants. So you may be seeing buy the rumor and sell the fact. Now for bonds, we will be taking profit on longer maturity US bonds and consider shortening maturities to our preferred 5 to 7 year range. A rebound in the US 10-year government bond yield towards resistance in the 4.2 to 4.3% range is a more attractive level to reconsider adding. The US dollar is said to be rebounding briefly, but we'll be using this to position for continued weakness in the weak dollar environment longer term. So the euro dollar is likely to be retreating initially towards 1.176. We're expecting a renewed push towards 1.2 thereafter. We will be adding gold on pullbacks. Finally, for equities, we will be adding to US technology sector stocks on any modest pullback and add to Asia ex-Japan equities to help avoid excessive US equities exposure. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.